Hello and welcome to today's video. If you are new to the world of investing in the stock market, you've come to the right place. In this video, we'll break down some common stock market jargon, explain how the stock market works, and delve into different types of stocks and explore the differences between common and preferred stocks. Make sure to stick around throughout the whole video to get a full understanding of what will be discussed. If you have not already, please consider subscribing to our channel, and most importantly, check the notification bell so you can be notified about our next videos. This video is for educational purposes only. It does not constitute any financial advice. Always consult with a qualified financial advisor before making any investment decisions. So let's get started by diving into understanding the stock market jargon. First, let's talk about the bull market. This term refers to a period of rising stock prices and positive market sentiment. In a bull market, stock prices are on the rise and the overall sentiment of the market is optimistic. Think of it like a charging bull that represents the market's upright momentum and strength. During a bull market, investors are confident about the economy's growth prospects and the potential for companies to perform very well. This positive sentiment often leads to an increase in buying activities. Okay, imagine you bought shares of Tech Innovators Inc. at $50 per share during a bull market. Over the next year, the stock price steadily climbs to $80 per share due to strong company earnings and market optimism. This is how a bull market works. What about a bear market? A bear market is marked by falling stock prices and a generally pessimistic outlook. The term bear is associated with the animal's tendency to swipe downward, symbolizing the market's downward trend. In a bear market, investors are often more cautious as they are worried about economic downturn, corporate performance, and external factors affecting the market negatively. Okay, suppose you held shares of Global Energy Corp at $100 per share during a bear market. Over the next few years or the next few months, the stock price steadily drops to $60 per share due to declining companies' earnings and concerns about energy sector's challenge. That period of time is referred to as the bear market period. Remember, both bull and bear markets are naturally part of the market cycle. Recognizing these trends can help you to make more informed investment decisions, whether you're looking to take advantage of growth in a bull market or protect your investment during the bear market. So let's delve into the concept of dividend now. Dividends are an important aspect of investing that can provide you with a steady stream of income, and they're particularly relevant when it comes to stocks. Dividends are a portion of a company's profit that are distributed to its shareholders. When a company makes a profit, it has several options on how to use that money. It can reinvest it in the business, pay down debt, or distribute it to shareholders in the form of dividends. Dividends are often paid on a regular basis, such as quarterly, annually, depending on the company's policy. This payment can be a significant source of income for investors, especially those seeking consistent returns. Imagine you own 100 shares of a company that pays you an annual dividend of $2 per share. That means you'll receive $200 in dividends income each year as long as you hold these stocks. Dividends can be especially appealing to investors who are looking for more stable investments, such as retirees or these seeking a reliable income stream. Another option with dividend is to reinvest them. Instead of receiving your dividends payment in cash, you can use it to buy more shares of the same company. This can help you take advantage of compounding growth over time. Keep in mind that not all companies pay dividend though. Some may choose to reinvest their profits back into the business for expansion or other purposes. Therefore, when investing in stocks, it's important to consider whether dividend income aligns with your investment goals. This is it for this video. Make sure to subscribe to stay up to date with part 2. Don't forget to hit the notification bell so you can be notified when part 2 is released. Thank you for watching, and we'll see you in the next part.